Well, good afternoon, everybody, and thanks for joining us today. We've got a number of folks on the line today, and we just want to say thanks before we get started for sharing your afternoon with us. Before we get started, just a couple of tech tips. For those of you that have joined us before for webinars, you probably know the drill a bit. But first, we want to make sure that everybody is set up so that you can view the webinar today in full screen. So on your screen, just a couple of tips for you to make sure you're viewing it correctly. If you'll start there at the upper right-hand corner of your Zoom screen, and you click on the view icon. At the bottom, we want to just make sure that you click on standard at the top and full screen at the bottom. So we'll give you just a second to make sure you're set up to view it in full screen. Second is we always love to have questions. We want to make this as interactive as possible. We've learned in the past to mute everybody's line so we don't get all of the background noise. It's not as if we don't want you interacting with us. We just want to invite you to ask questions via the chat box at the bottom of your Zoom screen. So as you'll see, kind of right in the middle of your Zoom screen at the very bottom, if you kind of scroll your mouse over it, you'll see the menu pop up across the bottom, and you'll see a chat icon. If you'll just click on that and type your question into the chat box, we'll certainly stop at multiple times throughout the webinar here to answer questions. So no need to wait for the end. Ask them as we go, and we'll pause from time to time and make sure we answer questions. So real quickly on today's agenda, a full agenda. We're going to start by going through historical returns for the funds that our clients own. Also talk a little bit about how we see future expected returns in the market, given today's market valuations in different asset classes and different areas of the world. Then we're going to share with you some information on some important tax and contribution limit changes that we had for 2025 that you're going to want to make sure and be aware of because they'll impact what for a number of our clients are going to be some important financial planning strategies that they take advantage of each year. Then our operations team is going to give you an update on 1099s for tax season this fall and what you should expect there. And then we've also got some great tips for you on cybersecurity and how to interact with the Schwab mobile application that you'll want to make sure and take note of. And then finally, everyone on here should have gotten an email from us this weekend with just a little bit of an update from the firm. And we're going to share some more details on that with you, as well as just some updates on the team members here at Aspen Capital Management. So we've got everybody in the room here today to participate and share with you. So again, please use the chat bar, the chat box there at the bottom of the screen to add in any questions you've got, or frankly, any comments that you just want to share with our team. To start out today, Nate, Miranda, Jake, and myself are going to share some information with you on historical performance of the funds that our clients own. But before we get started, we just want to set the stage for you and remind you of what historic performance looks like for asset managers, just to make sure you're thinking of this as we share the data with you on the funds we own through kind of the right lens or the right context. So if you look at the bottom row here, you'll see if we go back 20 years ago and we look at the past 20 years of performance for asset managers, just using the U.S. equity asset class here as a guidepost. 20 years ago, there were a little over 2,800 asset managers that were managing U.S. equity portfolios. If you look at their success rate over the last 20 years, you'll see a little less than half of those managers actually survived the period. So that means that their fund was either closed or merged into another fund over the last 20 years, almost always because of poor performance. The teal blue bar there, the 18% that are winners, a winner is simply defined here as a manager whose 20-year performance was better than that of their benchmark index. So over the long term, the probability that an asset manager will outperform their benchmark index net of fees and expenses is less than 1 in 5. So as we talk about outperforming a benchmark, we just want to make sure that you know we're not talking about average performance when we're talking about outperforming a benchmark. It's actually exceptional performance leads to long-term performance better than that of the benchmark.
Great, thanks, Mike. We're now going to take a look at the funds that our clients own and their performance over a few time periods against their benchmarks. But first, I do want to make sure we all know exactly what we're looking at here. So the blue circle is the return of the U.S. core equity fund that our clients own, which is a dimensional fund, over the 1-year time period or calendar year 2024. The green circle is highlighting the return of a benchmark index fund that is most similar to the dimensional fund right above it. And what is important to understand here is that we're showing the performance of a real index fund, specifically an iShares index fund, so that we can track the return of the fund less an expense ratio to make a real apples to apples comparison between fund performance. Below that, in the purple circle, the negative number indicates that the fund that our clients owned underperformed the benchmark index over that specific 1-year time horizon. If the number is green and positive, that means the fund outperformed its benchmark index fund. And as you look across this slide, the 3 U.S. equity funds that our clients own, and the next slide, as we'll see in a moment, you'll see a large majority of these funds outperforming their benchmark index funds, especially in that mid to long-term time horizons. Now, as we transition out of U.S. equities and into international equity, emerging market equity, global real estate, and U.S. bonds, we see a very similar story in the data. And while we may see underperformance in the short term, maybe 1 to 3 years, the funds that our clients own are consistently outperforming as we extend that time horizon. There are a few key takeaways as you look at this data here. The first is you have to be different from the benchmark in order to beat the benchmark. In all of investing history, there's only one way to reliably, or at least stack the odds in your favor of outperforming a benchmark index, and that's to do so over long investment horizons and to be willing to take on tracking error, which is just a fancy way of saying being different from the market. The second key takeaway here is that short-term returns are incredibly noisy and highly unpredictable. And similar to what I was just saying, there are no free lunches with investing, especially over those shorter time periods. And your goal is not to hit home runs every year, it's to be on base as much as possible. The third takeaway here that ties these 2 points together is that capturing those premiums that we talk about, the value premium, the small cap premium, profitability premium, it takes a disciplined long-term approach. And to kind of drive that point home, this is probably something you've heard us say, but risk and reward in financial markets has been and will always be linked. And one of those risks you are being rewarded for in tilting your portfolio towards those premiums is that you may underperform over shorter time periods. Just like stocks can be more risky than bonds over certain time periods, but they ultimately have a higher expected return over long investment horizons. And lastly, as you can see here, there is a lot more green than red. And in fact, something you may notice here is that no fund has actually underperformed when you look at it since inception date on this slide and the previous one.
So Nate, as I look across these slides, it's obvious that not just the majority of those time periods are in the green, but that in the 10-year time period and even beyond, every single fund has outperformed except for one. Can you explain why that is and what this means for future expected returns?
Yeah, it's a great question. And I'm actually going to go back to that first slide so we can take a look at that. So what Miranda is talking about here is that US core equity fund 10-year return. That's the only 10-year return or beyond that's red. And Mike is actually going to spend a lot of time discussing this in more detail. So I'd first urge you to keep that question on the front of your mind as we continue through these slides. But the short answer is that US equity returns over the past decade have largely been driven by large cap growth stocks. And those stocks increase in valuations over the past decade. And while this has been a very fruitful decade of performance for all US investors, if your portfolio is slightly tilted away from large cap growth stocks, you've seen a little bit of underperformance against the benchmark over that time period. Now, what's really important to understand here as we go on is that the increase in valuations across this sector of the market, with that increase, the US market is now at its one of its most concentrated and expensive times in history. And in that same time period, we saw those premiums show up outside of those US large cap stocks, like small caps and international, where you see all that green. Now to answer that second part of that question about what we see going forward and what does this mean for future expected returns, to us, there has rarely been a better time to be a globally diversified investor with tilts towards these premiums that we talk about. While the US has done very well over the past decade, what you see in the global markets and the bond market is a return lower than that of their long-term averages. And if financial markets are anything, they are cyclical and they're mean reverting. Now, does this mean we can forecast what 2025's returns will be? The answer is absolutely not. And that's actually probably a great transition into Jake's slides because, spoiler, sorry, Jake, that inability to forecast over the short term is not just something that we are unable to do at Aspen Capital.
Yeah, thanks, Nate. We just reviewed the returns by asset class, and as you can see from both the screen and Nate's comments, that 2024 was a good year for markets, especially US equities. And what we're going to take a look at now is how those recent real returns compare to the forecast made at the start of the prior year by some of the leading investment firms in the world. And really the question we're trying to answer here is, were these firms able to predict the returns we've seen in advance? So before we get into those details, just let me orient you to the slide. The data here compares equity analyst predictions versus the actual returns of the S&P 500. And when I say equity analysts, I'm talking about teams of researchers and portfolio managers at some of the largest financial institutions. So think of JP Morgan, Goldman Sachs, UBS, Morgan Stanley, Wells Fargo. You get the idea. These are the firms that you would consider Wall Street and some of the people you'd see on CNBC or potentially read in the Wall Street Journal. So if we come back to the slide, along the vertical axis, you have the calendar year return, which ranges from negative 30% down there at the bottom to positive 30% at the top. And along the horizontal axis, you have the calendar year. So if we come over to the right side of this screen, we'll start with calendar year 2024. You can see here in this bottom red dot that the low analyst estimate for 2024 was just under negative 10%. The median analyst estimate in that kind of teal or blue color there in the middle is going to be your median analyst estimate, slightly positive, but low single digits. And then there at the top, you have your highest analyst estimate for 2024, which was just under 10% and slightly below the historical average, that yellow line of the S&P 500 for the time period they're looking at here. Now, where did we actually end up in 2024? Nate just showed us some of the data. We know that the actual S&P 500 return was significantly higher than that of any of the major investment firms' estimates for the calendar year. and US markets finished up over 20% in 2024. Now, if we go back and look at previous years, how does this compare? Was 2024 an anomaly? Are forecasters usually this far off? These are the things that we're trying to look at and understand, as it helps us inform our investment decisions. If we look at 2023, you'll notice that the S&P 500 actual return was up here, again above 20%, so two great back-to-back years, and right on with that highest analyst estimate. And yet almost all estimates for those leading investment firms were well below, with the median down here again at the low single digits, the actual return of the S&P 500. If we go back to 2022, it's the same trend, but just to the negative side. The actual S&P 500 return was negative 20%, actually a little bit below negative 20%, and well below any of the estimates for that year. 2021, it's the same story here. The S&P 500 return was exceptional in 2021. Over 20%, closing in on positive 30%, and well above those analyst estimates, even on the high end, which for 2021 were quite positive. This is actually the only calendar year in the data set that we'll look at where all of the analyst estimates were positive for 2021. The S&P 500 and US markets just did that much better. And lastly, for 2020, if we go back to COVID year, right, where there was some significant volatility, the actual return of the S&P 500 was above that of the historical average and well above that of the analyst estimates for the year. And this was a year where in March of 2020, and within just 30 days, US markets declined almost 30%, and yet finished up over 10%, closing in on 20% for the year. So what does all this tell us? First, market forecasts, even from some of the most well-financed and informed firms and research teams, are almost always wrong, and they're usually off by quite a large margin. As you can see here, these green dots are really nowhere close to the median or even the outliers for the analyst return, or for the analyst estimates. Second is that returns are often far from the average, both to the high and low ends. So again, returns are almost always driven by what we can't predict, whether that's COVID in 2020 or the AI boom of the last couple of years, which has powered two great back-to-back years for US markets. Finally, I'd say continuing that trend of US markets and focusing in specifically on US large cap growth, it's been an exceptional run for the last 5 years. So as you can see, in 4 out of the last 5 years, the S&P 500 return has well exceeded its historical long-term average return. In 3 out of those years, it's been above positive 20%. And while that's been really beneficial to investors' portfolios, it's put us in a position where parts of the US market have become incredibly expensive on a valuation basis. So Mike's going to talk a little bit about that. We'll get to some questions. But this is some information that we wanted all of you to know on how US equity markets have looked compared to what people expected, as well as the long-term historical return.
Jake, I was just thinking as I was looking at this slide, our long-term clients know that we don't make market forecasts, right? We never have in the 23-year history of the firm. If you're a newer client to the firm and you wonder why, I think this is a perfect example of why. As Jake mentioned, these are all the largest, most well-funded firms on Wall Street. They've got armies of analysts and nearly unlimited computing power, and their track record for forecasting markets is absolutely abysmal. And in fact, not even anywhere close to what actual market returns have been. So this is a good, I think, description of why we've never been in the business of trying to forecast markets. Now, as Jake mentioned, interesting note, these last 2 years, 23 and 24, this is actually only the 5th time in the history of U.S. capital markets that the S&P 500 has been up over 20% in back-to-back years. And as you mentioned, Jake, right, 4 out of the last 5 years, we've had fantastic returns. At the end of the day, that ultimately takes its toll on valuations. And we're going to talk a little bit about that. Before that, I want to just share the framework with you to orient you and make sure you know what you're looking at. What we're doing here is we're going to map for you global market valuations based on two different valuation metrics. So on the vertical axis, we're using the price to book ratio, a very well understood and well-known valuation metric in financial markets. And on the horizontal axis, we're using the price to earnings ratio, probably the most well-known valuation metric that most investors think of. So if we think about this as we plot different countries, if somebody ends up in the upper right, that means they're expensive on both a price to book and a price to earnings ratio. That's going to be an area of the world that's quite expensive. And of course, if they're in the bottom left, that's going to be a market that's going to be more cheap, or in some cases, if they're in between, something that's probably very fairly valued. Well, what we've plotted for you here in blue, the blue dots are going to represent individual countries. This is going to include both developed markets as well as emerging markets around the world. The red dots are going to be an aggregate of different regions of the world, or aggregate markets in general. So I'll give you a second to just take a look at this. You'll see that in aggregate, most of the world is in that sort of bottom left quadrant and very fairly priced, and in some cases, probably even quite cheap on a valuation basis. But if you're having a hard time finding the US, let me help you out, because it's actually off the chart all the way up here in the upper right-hand corner. It is extremely expensive on both a price to book and a price to earnings basis, right? And this is the last 5 years of performance taking its toll, right? Where the US markets have become quite expensive. Now, I mentioned that takes its toll. So as we shift and we think about what does this information tell us with respect to future expected returns? On one hand, we would tell you it tells us almost nothing about the short term. Because if you're a long-term client of Aspen Capital Management, you know that the data has actually looked very similar to this for many years over the past, right? Which is a signal to you that expensive markets can stay expensive for a long time. And frankly, cheap markets can stay cheap for a long time. And that's why using valuation metrics to try to time the market historically has been a fool's game over the short to even midterm. But it does actually tell us quite a bit about the long term. So the data we're sharing with you here is data for the S&P 500 index, so the US large cap equity index. And it's looking backwards and breaking the S&P 500 index valuation down by deciles. On the right, you're going to see the cheapest decile historically when the US market was trading in its cheapest decile. Okay, so that's going to be a price to earnings ratio below 10. And then on the far left, you're going to see what is historically the most expensive decile, which is when the US market's trading at a price to earnings ratio above 26. Okay, today it's trading above 30. And what the blue bars represent is they represent the subsequent or the next 10-year returns for the S&P 500 when its starting valuation point was in each of these deciles. So we've also graphed the green horizontal line across the middle there that really shows you what's the long-term average return of the S&P 500. And probably not to anyone's surprise, you'll see that on the right-hand side, when markets have been cheap on a valuation basis, their future 10-year returns have been above historic average. And likewise on the left-hand side, and we've highlighted the decile that we're in today, which is the most expensive decile historically, future expected returns have been below historic average. Now, the one thing I will point out to you here is this is a 10-year period, right? So this says absolutely nothing about what could happen over the next 1, 3, or even 5 years. But it does tell us that as investors, we'd probably be naive to expect returns of the last 5 years to continue in the future. Trev, you want to check online and see if we've got any questions?
Yeah, it looks like we got two questions that came in. The first one is many investment firms are adding in alternative forms of investments such as private equity or hedge funds. What are your thoughts on this and what role do you view this playing in a portfolio?
Yeah, it's a great question, and we could actually probably do an entire webinar on this topic and this question alone. But let me take a crack at answering that in a concise way. I would say we always start with our objective is to always put the odds in our client's favor when it comes to investing. So when we look at the alternative asset marketplace today, that usually is made up of three different asset classes: private equity, hedge funds, and venture capital funds. Many would also include private real estate in that area. What we know historically about those asset classes, and by the way, we have a fair bit of experience here at Aspen Capital Management. I started the firm after a career in venture capital. Lavia Thomas came to us after a career in private real estate. So we certainly have some background in historic returns in these asset classes. But what we know historically is that the alternative markets and the private markets actually act very differently than the public markets. And what I mean by that is that the dispersion of returns over time in the alternative investment space is actually quite large. And what we see is that the difference between the median return and the mean return are substantially different. And the reason that is because in each of those asset classes, you have a few firms who have outsized performance that drive the average return up, while the median return is actually quite poor. Okay, so we've got a small number of firms that appear to be exceptionally good at what they do, and they affect the performance for the entire asset class. So, of course, our first question then is, can we gain access for our clients to those top performing firms that are driving most of the returns for the entire asset class base? And the problem with that is that we can't. And the reason for that is the very best managers, if you look back historically, are closed to new investors. And not only can we not get your money into those funds, nobody can get money into those funds because they've been closed to new investors. And in many cases, they've been closed for years. So an example I would give you here is Renaissance Technologies, by far and away one of the top 2 or 3 leading hedge fund firms historically. Renaissance Technologies has a fund called the Medallion Fund. That fund has been closed to new investors for, 15, maybe going on 20 years now. And not only have they been closed to new investors, but they've actually kicked existing investors out of the fund. And that fund now only manages the capital of the partners at Renaissance Technology. So we have no ability to get access into that fund that we know has driven phenomenal returns historically. Now, Renaissance Technology has actually launched other funds and other investment strategies over the years that are open to outside investors. But when you look at the performance of those funds with different strategies, their performance is horrible. And in fact, it's so bad that those funds have been bleeding assets from investors taking money out over time. So a combination of really high fees certainly has driven part of those lackluster returns for the bulk of the industry. And then you add to that the illiquidity. Normally, when you participate in one of those investments, you're locking your money up and your money's inaccessible for at least a decade, and in many cases, even longer than that. So it's an area we look at all the time. We look at all the research on it, and it all comes down to we have no confidence that the probability of our clients getting a better return in the alternative markets is better than that of the public markets. So that's the main driver, Trevor, on that. What I would say, one other comment I would say on the private alternative markets is always follow the incentives. And these funds and these different markets are being marketed very heavily right now by a lot of different advisory firms and large banks and Wall Street firms. Always follow the incentives. These things come with exceptionally high fees. Private real estate was sort of the hot area a decade ago with exceptionally high fees. You've seen the returns a decade later in that space have not been exceptionally good. Today, you're seeing a lot of noise around private credit as well as private equity. Again, always follow the fees and follow the incentives. Any other questions, Trev?
Well, it looks like we had another one come in, and I think it came from the fund performance slide, and it is, will you please speak to the DFAPX fund as it seems like it has been a drag on the portfolio?
Yeah, let's actually go backwards. Sorry, everybody, we're going to have to take a second here and find our way backwards. So DFAPX is going to be the bond fund here at the very bottom of the page. And Nate, let's tackle this one together. But I would say people ask, has that been a drag on returns? Certainly bond returns, over the last 5-year period have been roughly non-existent, right? If you look at the 5-year returns, yes, bonds have been a drag on the portfolio. So I guess two thoughts there. One is, as far as the fund itself, you'll see that fund has consistently outperformed its benchmark index from the 1 year to the 10-year to the since inception period. So we couldn't be more happy with that fund selection as part of the bond investment asset class. Now, if we look at bonds in general, I would come back, Nate, to the role that bonds play in our portfolio, and that is the role of reducing volatility. There's going to be periods of time, just like with equities, Nate, where an asset class has above average return and below average return. We can't control the return of the asset class. We can control the return of the fund that we own. But yeah, we've come off of a period where bonds have not performed well, but they have certainly been that diversifier in the portfolio. So as an example, I would say if we go back to COVID and we go back to the first quarter of 2020, right? The role that bonds play in our portfolio is as a diversifier versus equities when equities have high periods of volatility. And not only did this fund, but bonds in general were in fact that great diversifier. In March of 2020, equities faced their swiftest decline of 30% or more ever on record. And bonds actually had a slightly positive performance in a roughly 2-month window when equities were down by a little over 30%. So I'd say they're doing their role in the portfolio, and we've certainly had a 3 to 5 year period here where, due to rising interest rates, bonds have had below historic average returns. Nate, anything you'd add to that?
Yeah, I guess I would. Yeah, you kind of hit the punchline there that fixed income's role in the portfolio is not really to drive return, but to reduce the portfolio's volatility, how much it goes up and down year over year. And what we've actually seen, and what you can actually see here, but the volatility, or a technical term that we'll use when talking about this, is standard deviation. How much does it go up or down in one year? The volatility, or the standard deviation of bonds over these same time periods, has been far lower than that of US equities, international equities, emerging market equities. So it's not only a diversifier in that it's either negatively correlated or low correlation with equities, meaning it doesn't perform the exact same over time periods, but it has had lower volatility, and it's performing like we'd expect it to in its role in the portfolio.
Any other questions?
Nope, that is all the questions for now. Next, Livia and I are going to be talking about some important tax updates for 2025 and beyond. There were modest increase made to contribution limits in the standard deduction. These are smaller increases relative to 2024 and 2023 due to the lower rate of inflation. Let's start by reviewing the important updates to contribution and gifting limits for 2025. The annual gift exclusion amount has increased to $19,000 per individual, or $38,000 for married couples. This means you can transfer more wealth to loved ones tax-free, which could be a significant factor for your long-term estate planning strategy. Contribution limits for IRAs remain the same at $7,000, but Roth conversions, or backdoor Roth IRA strategies, maximize tax-free growth for the future. Remember that eligibility for Roth IRA contributions may still be subject to income phase-outs, so planning early in the year can ensure you don't miss out. For those over age 70 and a half, the QCD limit is $108,000 per IRA owner. Leveraging QCDs can help reduce your taxable income while supporting the causes that matter to you most. Social Security benefits are increasing by 2.5% in 2025, following a 3.2% cost of living adjustment in 2024. This highlights the importance of reviewing your retirement income strategy annually to ensure it aligns with your spending needs and inflation trends. Lastly, the employee contribution for 401k plans increased from $23,000 to $23,500 for those under age 50. Catch-up contributions for individuals aged 50 to 59 and older than 64 is now $7,500. That allows you to contribute up to $31,000 if you are aged 50 through 59 and 64 plus. Something new this year is an additional catch-up amount for people still working at age 60 to 63 for a total 2025 contribution of $34,750. This change represents a unique chance to maximize tax advantage savings as you approach retirement.
Thank you, Trevor. It is nice to see increases across several retirement savings account maximum contributions. I was curious, with these updated contribution and gifting limits, what strategies should someone consider to optimize their tax-efficient savings and wealth transfer?
Yeah, that's a great question. I recommend being proactive and maximizing retirement contributions based on your tax situation, leveraging gifting strategies if you are trying to move money out of your estate over time, and make sure you have a tax-efficient withdrawal strategy. These are things we do every day for clients to ensure any adjustments align with your long-term financial goals.
Great. Now let's shift gears and talk about the possible tax policy changes that could impact your plan later this year. I will caveat this by saying none of these are finalized yet. It's important to understand what's being discussed, or shall I say, heavily and dramatically negotiated. Interestingly, the Tax Cuts and Jobs Act was a tax law written under the Trump administration in late 2017, and this very same law is now set to expire at the end of 2025 under the same administration who wrote it. This creates an interesting tension between being motivated to extend the tax cuts while not drastically increasing the budget. As we have seen already, changes to this law will be yet another negotiation with several bargaining chips on the table. If Congress does nothing, the tax cuts will expire at the end of this year and tax rates will revert to pre-2018 levels, meaning that 2026 tax rates will be higher. The estate exemption will decrease as well as the standard deduction. If Congress votes to extend it as is, then the current income tax rates continue, as does the larger standard deduction and lifetime estate exemption. But remember, lawmakers are faced with the challenge of balancing the cost of extending the Tax Cuts and Jobs Act without significantly adding to the national budget. So we don't know how it will change, but we expect that there will be a change to the tax law by year end. Candidly, any changes add to the importance of having financial planning discussions. And while our friends in Congress could surprise us with an early decision that would allow for ample time to plan, there is a high probability that a final decision doesn't come until late this year. This leaves little time to make changes to your savings or withdrawal strategy. So now will be a very helpful time to begin thinking about it. So far, the most talked about changes are the state and local tax deduction cap, also known as the SALT deduction. Now, several bills have been introduced that promise some sort of a modification to the current $10,000 SALT deduction cap, but there doesn't seem to be a clear direction as of the date of this webinar. So in short, if the cap is repealed entirely, then certain taxpayers in higher tax states might then be able to reclaim larger deductions for state and local taxes. If the current cap is extended or significantly increased, then certain taxpayers would have a further reduced federal taxable income by the amount of or portion of state and local taxes paid. The key point is that any change to the SALT cap deduction will impact decisions related to real estate, property tax prepayments, and residency decisions if you're contemplating moving to a different state. Also up for negotiation is the lifetime gift and estate tax exemption. So unless changed through legislation, the lifetime gift and estate tax exemption will drop to roughly $7 million, and the 40% tax on dollars above the exemption amount will be permanent. This could significantly reduce the amount you can pass to heirs tax-free if your estate is over the exemption. There's also some talk about modifying the estate tax exemption to an amount somewhere in the middle. We recommend talking to your estate planning attorney if you are considering larger gifts or estate transfers, or if you think your estate could be adversely impacted by a lesser estate tax exemption. It is worth evaluating different options contingent upon actual legislative changes. A few other discussed changes are reduced corporate income tax rate, potentially making 100% bonus depreciation permanent, some changes to alternative minimum tax threshold, and extending the qualified business income deduction. The bottom line here is that at Aspen Capital Management, we are all monitoring updates and legislative actions on an ongoing basis. There will be plenty of headlines and political noise speculating the changes, but no one really knows what the outcome will be before it's actually voted on. And regardless of the outcome, the tax policy changes offer both opportunities and challenges, which is why we are here to help you with advanced planning that allows for flexibility.
Livia, it looks like we had a question come in, and that is, with these changes potentially being finalized later in the year in 2025, what's the best way for individuals to stay informed and ready to act quickly?
That's a great question, Trevor. Remember, one of the services we offer to our clients is to work with your professional team to coordinate planning strategies. So I encourage clients to leverage this service so they can feel confident about having a holistic approach related to any of these changes to help them with their financial, tax, and estate planning needs. We are always happy to join a conversation with your estate attorney and or your accountant to make sure you have a fully integrated solution that fits your needs. And if you need an introduction to build your broader professional team, please reach out to your advisor and we will be happy to make an introduction. As always, our goal is to keep you informed and feeling well prepared, whether it's maximizing contributions to your accounts, utilizing gifting strategies, or navigating the ever-evolving tax landscape. We are here to help.
Livia, it looks like we just had one more question come through, and it looks like it's a clarifying question, which is, do changes to the Tax Cut and Jobs Act affect 2025 taxes?
No, so the tax code as written will sunset on December 31st of 2025. And then if it expires entirely or gets modified, that will impact 2026 taxes and potentially beyond.
Yeah, Trevor, the one thing I would say is if you talk to any accountant, what any accountant fears right now is what's happened in the past, where they pass legislation late in the year that's retroactive. So the reality is we won't know what impacts 2025 until the legislation passes. We would hope that it wouldn't be retroactive to January 1st, but there are lots of examples in the past where something's passed in November, even December of a year that's retroactive to January 1st. So no promises until the final ink dries on that legislation.
Great. Thank you, Mike. This is Rachel Lisney with the Aspen Capital Operations team. And today the ops team will be covering some important information about Charles Schwab as it relates to your 1099s and cybersecurity. You'll be hearing from each member of the team, Bryn, Miranda, Nate, and myself. Miranda is going to start us off with some information about 1099s.
As you may already know, Schwab releases 1099s in several stages, beginning now in February. Most clients can expect for the first round of 1099s to be released during the second production run in mid-February. Once your forms are released, you'll receive communication directly from Schwab, and you can access them by logging into Schwab Alliance directly, but they'll also begin filtering into your ACM client vault. In mid-February, Schwab will begin to issue any necessary corrections. And as usual, we recommend waiting to file your taxes until after the second round of corrections have been released in mid-March. Additionally, we have some great news. Some of you may remember receiving separate 1099s for TD Ameritrade and Schwab last year due to the merger. But this year, all your forms will come from Schwab, so there won't be any TD Ameritrade forms to worry about.
Great. Thank you, Miranda. That is good news, as I'm sure you all remember with the complication last year of the two different 1099s. So I will be covering some fraud tips to keep in mind, which are based on the prevalent sort of cybersecurity and fraud trends that we're seeing in the industry these days. So tip number one is to beware of both phishing and smishing. You may have heard of phishing before. It's when someone sends a fraudulent email to attempt to trick you into clicking on a link with malware or trick you into revealing sensitive personal information that they will then scam you with. And smishing is the same concept as phishing, but rather than sending fraudulent messages via email, they are sent via text. So if you get any suspicious emails or texts that ask you to click on links or reveal personal information, do not reply. And if you ever have any questions about your financial logins or accounts, please don't hesitate to reach out to us. Tip number two has to do with check fraud, which is kind of another prevalent industry trend. There are two things to keep in mind here. The first is to, whenever possible, use an electronic payment method instead of a paper check. So if you have the option to send money via ACH or wire instead of paper check, that is usually more secure. And if you are expecting a check for a large dollar amount, try to request a direct deposit instead of a physical check in the mail. Sometimes checks in the mail are unavoidable with retirement account rollovers and things like that. But at the very least, in that case, try to use a tracking number from the mail carrier. Lastly, tip number three is, rather than using search engines and clicking on the results to access financial websites, we recommend bookmarking known and trusted web addresses, then using those bookmarks in your web browser to access the websites instead. For Charles Schwab specifically, we recommend using the Schwab mobile app, which Bryn will talk more about. And as always, we just wanted to provide a reminder to please report any fraud and or suspicious activity to Aspen Capital immediately so that we can help you resolve any potential issues.
All right, awesome. Thanks, Rachel. So we highly recommend downloading the Schwab mobile app, like Rachel mentioned. It's by far the most secure way to access your Schwab accounts. It uses biometrics like fingerprints or facial recognitions to keep your account extra safe. This makes it a lot harder for anyone to impersonate you and get unauthorized access. Another great feature is how the app works for two-factor authentication when you log into Schwab Alliance on your desktop. After you enter your password, the app will send you a quick prompt to your phone asking you to verify your identity. It is a fast and secure way to double check that it's really you. But it's not just secure. The Schwab mobile app is super functional too. You'll get notifications and be able to access the message center where you'll find important updates and e-authorization requests. Nate is going to dive into e-authorization in a bit, but I wanted to point out how easy it is to securely approve requests directly from your phone. It makes everything quick and simple. Also, be sure to check out the tutorial library on our website under the Online Client Center. It's packed with resources to help you get the most out of the app, like step-by-step guide on how to download it, navigate its features, and use e-authorization. Plus, we have resources for some of our most asked questions that cover topics like giving family members view-only access on Schwab Alliance, how to use the Schwab mobile check deposit, and how to access your account statements and tax forms. These videos are a great way to get comfortable with the app, so definitely give them a watch if you want a quick walkthrough. Now here's Nate with more about e-authorization.
Yeah, so as Bryn mentioned, one great example of where cybersecurity and Schwab Alliance meet is e-authorization. Now, there's a good chance that you've already been exposed to e-authorization, so I won't belabor the details too much here, but Schwab's e-authorization is a method of digital signature that is more secure, has much lower rates of incorrect or errant processing, and is much faster than paper or DocuSign forms. Now, not all forms can be e-authorized, but when possible, Aspen Capital will request your digital signature using this method. And instructions and a link to complete e-authorizations are sent from a Schwab email. So always double check that sending address. Or you can log in directly to your Schwab Alliance account or Schwab Alliance mobile app and find these e-authorizations in your message center. Lastly, I'd like to call out 2 points of data on the bottom right-hand corner of the screen. And although we take great pride in this data as a company, the real thanks goes to you all as clients. On the Schwab platform, we currently sit at roughly a 93% overall tech adoption versus 62% for our peers and a 92% Schwab Alliance enrollment rate for our client base. So for those who transitioned from TD Ameritrade and those who onboarded on Schwab, this speaks volumes to your willingness to adapt. So thank you for that.
All right. So, hello, everybody. Thank you for still being with us. I'm going to wrap this up in about 7 minutes time, which is about 2 minutes shorter than what I have planned. So here we go. Buckle up. This is going to be fun. I get the fun updates today of our firm and our team updates. So I hope most of you saw the email that was sent out over the weekend, and we're really excited to share the growth of our firm. And I'll do that with a series of numbers. First, the number 10. We've added our 10th full-time employee in 2024. A growing client base needs more resources and will continue to add employees to ensure we have the people to meet our expanding client needs both now and in the future. As we've told you in the past, we're designing a firm that will be here for our clients, their extended family and friends for generations to come. The next number, 300. Thanks in large part to our clients' willingness to introduce us to their family and friends who have investment and financial planning needs in 2024, we began serving our 300th client. We're humbled every day by our clients' trust and confidence. If you take one thing from this information that you've heard, I hope it will be the overwhelming responsibility we feel to continue to earn your trust by providing unbiased advice that's always in your best interest. Providing unbiased advice was the foundational principle upon which this firm was founded about 23 years ago, and we come to work every day with a passion to educate our clients and help them make well-informed decisions. And now we get to do that for 300 families. The last number is 1 billion. We now manage more than 1 billion in assets for our clients. And wow, that's a big number, and most firms will never see. We'd be lying if we said we weren't proud of the accomplishment, but really, this number is simply validation of an idea or a business model, if you will. The independent business model has proven to be a winner, not just with us, but across the nation as clients are moving assets from high-cost brokerage firms and banks. Transparency, low-cost investment options, and acting in the client's best interest is winning, and we're really proud to be on the side of that movement. So I will just finish this section by saying 1 billion is not the end point, it's just the beginning. We now have clients in 32 states. The intersection of portfolio management, but financial and tax planning has never been more complex in your lifetime, or your sister's lifetime, or your brother's lifetime, or your neighbor's. So as you encounter the people in your life that you really care about with similar financial planning, investment needs, tax and estate planning needs, just know your team would be really excited at the opportunity to serve them and help improve their financial futures, and we'd welcome an introduction to you, especially in Wyoming. If you look at this map, we could really use a green in that just to kind of solidify the West Coast here. All right, moving on. Speaking of growth and our devotion to your experience, we're also proud to share the outcome of our recent client survey. Thank you to more than 50% of households that responded to the survey. We were humbled by your responses and we're grateful you took the time to share your thoughts. 10 out of 11 client satisfaction ratings, Aspen ranked above industry average. These were items like responsiveness and communication, explaining financial concepts, and my advisor offers a sense of security and peace of mind. We also heard you in your feedback of helping to quarterback your professional networks, and we're making improvements within our team to continue improving our process for you here. One metric we monitor closely is our NPS score. Now, the NPS score stands for Net Promoter Score. It's a metric that measures client loyalty and satisfaction, and it's a good metric to use to compare our clients' experience to other financial firms, as well as other great companies in an effort to deliver a premium experience to our clients. We are very happy to report our score was above 90. This was such a wonderful response. As you can see, the score came back higher than some of America's favorite brands, Starbucks being my husband's favorite for sure. It's also 2 times higher than most of our more direct competitors in the financial industry. While this metric is high, we know we can always get better and will continue to strive for an exceptional service that delivers continued education, trusted advice, and peace of mind. Thank you again to those who took the time to share their feedback. We're really grateful for that. Okay, lastly, this is the fun one. Last year was a year of love for Aspen Capital Management as we helped 3 of our employees celebrate weddings. Rachel married Drew, Miranda married Carter, and Bryn married Tyler. It was a wonderful kind of summer at Aspen Capital Management where we really watched our beloved employees take that walk down the aisle, and it was really fun for us to kind of grow our Aspen Capital Management through marriage. Another really important news update is Jake finally asked his girlfriend Faith to marry him, and believe it or not, she said yes, which is very exciting news for them. They have, I'm sure, a long engagement if we know Jake ahead of them, but really exciting news to just
At least a couple of years. Yeah. We don't want to rush anything.
That's right. He doesn't want to rush anything. And you guys have been dating for how long, Jake?
Well, just a few years, 7. So I don't want to rush.
7. They're not going to rush anything, but we're really excited for them and what lies ahead for them. And also, really important, and we're very excited and proud of this update. Our very own Nate, who you've heard from today, he is now a designated chartered financial analyst, or a CFA. Now, this is not an easy designation to get. In fact, it's one of the most prestigious for investment professionals. Nate has passed all 3 levels of a very difficult exam and has completed the steps to qualify for the CFA. Again, we're just so proud of you, Nate, and your accomplishment, and this will only allow us to deliver a better service for all of our clients. Nate is a man of few words. He's blushing right now, and a smile. So super proud of you, Nate. Okay, there we did it. I did it in 7.5 minutes, I think, Mike. If you're still on with us, I have one question for Mike that you might all be interested to know, because I'm interested to know. Mike, last year was an incredible year. Would you agree?
Absolutely.
Okay, so what was your favorite part of last year?
My favorite part was the data that Nate shared on our clients' 92% digital adoption. Is that right, Nate?
Correct.
Phenomenal. What most people don't understand is I actually had the opportunity the last 2 years to sit on the Charles Schwab advisory board, and in that process got insights to a lot of information. And Aspen Capital Management's clients put us in a position where we rank the highest of any firm in the country across digital adoption of our clients, which makes our lives much easier in servicing our clients. And while they probably don't realize it, it makes our clients' lives far more secure from a cybersecurity standpoint. And it makes our ability to work with them much easier by simply tapping things either through their website or through their mobile app.
Well, I thought your answer was going to be something about the Broncos, but we'll take that one too.
Yeah, the Fiesta Bowl was nice.
Yeah.
That was nice.
Yeah.
Trevor, do we have any other questions?
Yeah, it looks like we have 2 questions come in. The first one is, why would I get a corrected 1099?
That is a great question. So a corrected 1099 can be issued to you when an issuer updates their income classifications or they make changes in their reporting, which sometimes can continue even several months into the next year. And since Schwab relies on these issuers for accurate reporting, any changes that are made after the initial 1099s are released require Schwab to issue a corrected 1099 that reflects those changes. This is why we recommend waiting to file your taxes until after the second round of corrections, which just helps minimize the chances that you would need to amend your tax return later.
Awesome. And question for Nate. Has there been any progress from Charles Schwab's support for electronic QCD payments rather than writing checks?
Yes. Well, yes and no. The answer is yes, but it is actually a lot harder than writing checks. So this is something that we've looked at through the past year. So if you're writing QCD checks, and you've been doing that the past year, that's a decision we came to, because if we were to do these electronically, you would have to go in and approve every single check. You'd have to log in. We'd have to send you not just for like a group of checks, but for every single check. So when we came together and we decided, well, what we want to do is make this easiest for our clients to send checks, because QCDs are such a great financial planning tool. So having that checkbook in your hand, being able to send them when you want, as long as you have cash in the account, and also being able to take them places. So we've heard of some good examples of where clients have taken them to like an auction or something where it's for the benefit of a charity. And it's a lot easier to just have that checkbook in your hand ready to go, instead of having to reach out to us and then we've got to get the paperwork ready and then you've got to log into your Schwab Alliance. And so it's really just that yes, they have that ability, but as we looked through it, it's not an ability that actually makes your lives as clients easier.
Nate, I think I know where this question might be coming from, but I just want to make sure that everybody's clear on this. But is there any way for clients to go on to their Schwab portal and electronically do a QCD?
Okay, yeah, that's a great clarification. No,
That's,
that is,
I think,
that is something
I
you
think that might have been where the question was coming from on like, hey, is there any way that I can easily just go in and put in the charity's information and make that QC electronically?
currently no. But that is definitely something we'd love to see. And we'd love to see Schwab kind of gain that capability. So it's absolutely something that kind of feedback we'd give Schwab, and we'll let you know if that becomes a capability in the future.
So for our younger clients out there that are sitting here, we've used the term QCD about 15 times today. For our younger clients that wonder what we're talking about, a QCD is a qualified charitable distribution from your IRA. You have to be age 70 and a half to be able to qualify for it. So if you're a younger client sitting out there wondering what we're talking about, you're not missing anything. We will make sure and make this very clear to you once you come upon age 69 or 70 years old. So it looks like we're out of questions. Just a quick reminder to everybody that we are recording this today. So if you have any interest in going back and replaying of it, any of it in the future, we will post it to our website and we will send you an email when it's available. Also, if you've got a friend, a family member, a coworker that you think would benefit from any of this information, make sure and send them our link. Let them know it's on our website. We'd love the more people we can help educate that can take information away from this that's beneficial to them. We would love for them to participate. The same thing goes for the slides. If anybody listening would like a copy of the slides, either for themselves or to pass on to someone they know that they think would benefit from it, just shoot your advisor an email and we'll make sure and get you a copy of the slides. Otherwise, thanks everybody for taking the time to join us today. If you do have some follow-up questions as you think this material through over the next few days or a week, feel free to reach out to your advisor and we'll be happy to get your questions answered.